This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
Today, our guest will be a returning guest, and that will be ITR Economics, as we take a look at what we can expect from the economy in the upcoming year. I think this will be very fascinating for you. Before we get to that, I've got a couple of things of my own to share with you, not the least of which is we are all pondering whether or not the Federal Reserve has achieved basically a miracle. And I think maybe they have. I was very critical of the Fed, and I talked about this on the last episode. I think they let the money printer and the quantitative monetary policy run way too long, and I think that was a big mistake. I think Powell was denying inflationary pressures in the system, saying it was transitory, but it was long past transitory. It was long past supply chain issues, which, by the way, those seem to be rearing their head again. We'll see how that goes. But by the way, it's interesting. You look at the role of the United States in the world, and you look at these drone attacks on shipping routes and so forth, and the U.S. Navy is just there to police and protect commerce and capitalism throughout the world. It is truly an amazing thing and bodes very well for the long-term strength and hegemony of the US dollar. Now, do I necessarily like dollar strength? Philosophically, sure. I mean, look at this. We have a whole new country. Well, not a new country, but a new leadership, right, of this country, of Argentina. I'm talking about Argentina, that is saying they like the US dollar so much, they want to put their entire economy on the US dollar. If that isn't a testimonial, I don't know what is. It's pretty amazing. But has the Fed achieved a soft landing? And, I think they have. And they have managed to restock the shelves, to reload the gun, however you want to put it. It's not even politically correct to say the word GUN anymore. You have to deny the existence of these things, right? These things that create equality, honestly, right? Think about it. What makes a little old lady walking the street at night equal to a big, giant warrior gangbanger, right? Well, equality is created with GUN. That's what makes them equal, right? So that little old lady can be protected and have the same strength, the equal strength of that big bad gangbanger, that big bad criminal, right? GUNs, they make for equality. Okay, not enough of that. But they have reloaded, right? The Federal Reserve is ready for the next crisis. They're in a pretty darn good position all of a sudden. And there's more to it than that. I get it. I know there's more to it. I don't need a bunch of criticism that, Jason, you're oversimplifying this. I know there's more to it than that. I know they have their own balance sheet to think about. I get it. But I'm just looking at the macro picture. And have they achieved that soft landing? I think maybe they have. Now, barring some unforeseen event, whether it be a pandemic, an act of terrorism, a new war, that's all we need, another war, right? All of these things are obviously things that could change the trajectory, right? They obviously could change things. But overall, when you look at the basic economics of what the Fed has achieved, it looks like they pulled it off, right? Look at this article. This is an AP article, Washington, D.C. It was the most painful inflation Americans had experienced since 1981, when the Dukes of Hazzard and the Jeffersons, we're moving on up to the top. Some of you don't even know what I'm talking about. We're topping the TV charts, right? Yet the Federal Reserve now seems on the verge of defeating this inflation. Right? Without a surge in unemployment, without a deep recession that many economists had predicted would accompany this policy by the Fed, right? Inflation has been falling more or less steadily since peaking in June of last year at 9.1%. Okay. Now, the cost of goods such as used cars, furniture, and appliances have fallen for 6 straight months compared with a year ago. Goods prices are unchanged, held down by improved global supply chains. Now, the supply chain problem kind of having a little bit of a threat right now, as we all know, but this is short-term news, right? And all of these YouTubers and all of these gloomers will make a big giant deal out of this stuff that is more of a fly in the ointment than a systemic problem. Right? They do that. And then what they do when they've been proven wrong, when their predictions just sucked, they simply just remove the videos. So everybody forgot they said that, right? Yeah. We don't remove any videos, folks. We haven't removed any, okay? We haven't removed any podcasts. The podcasts are numbered. So you can just go back and listen to them. And if a number is skipped, then you'll know we probably took one down, okay? The Federal Reserve, well, we'll see. We'll see where they go with this. Okay, let's look at a couple of markets before we get to our guest, a couple of local real estate markets. And this is important. This is active inventory changes year over year and compared to 2019. Now, why is 2019 an important year? Well, it was before anybody ever heard of COVID, right? That's why it's an important year. So let's take a look at some of these markets and let's look at how they have acted differently, right? Let's look at how they've acted differently, right? So let's go to the first one that you can't spell, at least I can't spell it. It's Albuquerque, right? Albuquerque, 1,497 homes for sale. Last year, a little bit higher than that, 1,574. So inventory is down. And year over year, it's down 4.9%. But since 2019, Albuquerque is down by 1/3, by 33%. I'm not going to go over every market, but I want you to look at the ones in bold. And by the way, this comes from Calculated Risk, which is fantastic. I'm trying to get Bill on the show. We haven't booked him yet, but he's got some great data. Austin, Texas. This is one of those markets that was really a hybrid market that probably could be considered a cyclical market now, or at least it could, through its last phase of big change, could have been considered cyclical. So Austin has had real problems because like every cyclical market, it basically got overinflated and what goes up must come down. Now, Austin, Texas, right now, 9,300 homes for sale. Last year, 8,800 homes for sale. Obviously, you see I'm rounding off. If you're watching this on video, rounding off just slightly. And November of 2019, only 5,700 homes for sale. So the inventory in Austin versus 2019 is up a whopping 62% increase in inventory. Yikes. But that's really the only market where you could report something like this. Every other major market, way down in inventory, way down in inventory. Some of these are grouped by states rather than cities because, maybe they don't have big enough metro areas or whatever. I'm not sure why he does it that way. But if you just go down the list here, right? You look at even Detroit, inventory versus 2019 is down by 48%. Grand Rapids down by 49%. Houston up a little, only a little, by 2.3%. This is versus 2019, okay? Because the COVID era was, that was weird, right? So we're just going to go 2019. Maryland down by 50.9%. Very little inventory in Maryland. Memphis down by 11.3%. Less inventory there. Minnesota down by 29%. Sacramento, my Aunt Joan, who's been on the show, who's spoken at a few of our conferences, right? She owns a whole bunch of properties in Sacramento. Inventory down by 28%. So you just see that pretty much across the board, inventory is down, down, down. And remember, the one key ingredient you must have if you want to have a real estate crash is massive increase in inventory, millions and millions of distressed sellers. And as I predicted, and as I have been right, when everybody else has been wrong, just going to point that out, folks, inventory is declined. as we have this housing shortage. Now, I am almost finished with a big study on shadow demand versus shadow supply of housing. You're going to love this. I think I'll be ready to talk to you about this next week. I'm almost thinking maybe we should have a special Zoom meeting that I invite all of you to look at this, because over the holidays, I really, really worked on this and I just went down the rabbit hole. I get kind of compulsive about these things, folks. They really get interesting, and I just sit here and I just study. I look for this statistic, that number in the demographics, that number in the housing data. I merge these things together and come up with some really, really telling stuff. And this tells a big story, shadow demand versus shadow supply. So look for that on an upcoming episode. We'll talk about it there, of course, but I might do like an in-depth Zoom meeting about it and just invite all of you to it, because it's really interesting stuff. But overall, versus 2019, this is the overall for all of these markets in this study. Inventory is down by 23%, 22.8% to be exact. Inventory declined. And if you want to have prices drop, you just got to have more inventory, folks. The housing shortage is going to persist for quite a while. And that's what my big study is about. So look for more info on that coming up on a future episode. But without further ado, let's get to our guest today, and that is ITR Economics. It is my pleasure to welcome Brian Beaulieu back to the show. He is a returning guest. We've had many people from his firm, ITR Economics, on the show over the years. He's the chief economist there, and we are going to go into some very important economic data, some of which may really, really surprise you. But we're also going to answer that question, or at least try. When will the Fed pivot occur, and when will we see lower interest rates? Brian, welcome back. How are you?
Hi, well, Jason, and thank you for having me back. And while we're going down that path, of course, we're going to always have an eye toward what does this mean for real estate investing? The single greatest way of most people are ever going to create wealth. So it's vitally important. And
yeah, well, I'm glad you recognize that. Brian, I always say that income property is the most historically proven asset class in the entire world. And it's definitely the asset class that helps the middle class get wealthy, even the lower class. It's just an amazing asset class. And you know what else? It's amazingly resilient in the face of the cost of money tripling. It's still appreciating. Like, what other asset class could do that in this environment? It's just amazing how resilient it is. It can take a lot of punches.
Oh, it really can. And when you look at, for instance, multifamily housing, and you look at the pricing trends there, stock market could be in a bad bear trend, and it's going to hold its value, and it's going to continue to rise. We go through recessions, except for the Great Recession. And that space is amazingly resilient in terms of investment values. So I'm just echoing what you said with some data. It's a great place to be.
Yeah, absolutely. Yeah. A recession does not mean housing recession per se. So that's interesting to know. But tell us, what is your sort of macro outlook? I know you want to talk about some of the things on the global scale. Let's maybe go there and then circle around to housing. So let me know. Yeah.
Okay. We see the U.S., as measured by GDP, experiencing 2 or 3 quarters of decline non-consecutively in 2024. That makes it a very mild downturn. We're already looking at manufacturing in the United States running below year-ago levels. CapEx is already in decline. Corporate profitability is struggling, put it mildly, outside of the banking sector, which is a whole different mess. Europe's in recession. We got Russia in recession, which is a minor player, and China's rapidly unwinding any power that it once had economically.
Yeah.
So the world as a whole, and we look at the world data, is slowing down, and the U.S., as big and mighty as we are, it impacts us. And we have our own internal problems. You alluded to the interest rates, but it also matters to us when the rest of the world is slowing down. We feel it too.
Yeah, absolutely. Absolutely. So China, I wouldn't call them a paper tiger, but it's just so amazing how people still think that China is going to take over the world. And I mean, you just don't realize the severe problems China has demographically, economically, human rights, obviously. I mean, it's just truly amazing.
You were right. You were so spot on, Jason, because that upper line is the 312 rate of change for China industrial activity. And 312 rate of change is where you take the latest 3 months worth of data, you compare it to the same 3 months, but 1 year earlier. So the 3 is the number of months aggregated, the 12 is the time interval. And you were saying if people think of China as this great beast coming after us, and they're still stuck in this 2004 through 2012 paradigm in their thinking. What my simple chart is showing you is that China's rate of growth has been slowing since 2012, and they're now playing in the same territory as the US in terms of ability to grow, even though our economy is so much bigger than their economy is. It goes directly back to one of their major issues, which is demographics. Now, this red line here is China's population trend. You'll notice that it started going down in 2012 very gradually. And the ITR was talking about this 10 years ago. They could never overtake the United States because their demographic trend was turning negative. And you can see where the UN is forecasting it to be is in rather significant decline through the middle of this century. Outside of what happened during the potato famine in Ireland, the world has never seen this before. And the way this is going to matter is China cannot grow when its population is shrinking. It's impossible unless they're going to go out and conquer land and conquer people and grow inorganically that way, which obviously has very significant political implications. But, and this is where it matters for real estate investors, this sort of trend is also going on in Europe. We're the only major industrialized nation here in the US where it's not going on. India is now the most populous country on the planet, and they have their own weaknesses, and therefore they're not a major industrialized nation. Tying it into the real estate, Jason, is straightforward. There's going to be a round of deflation out there in the future as you see where about that China trend really starts to turn negative. That's about the same time it gets worse in Europe also. That's in the early 2030s. Right? That's going to lead to, instead of inflation, which we are fighting, just still are fighting and will be fighting through the end of this decade, that's going to mean that there's a round of deflation going on throughout the world, like we have seen
in the 2030s.
In the 2030s.
Okay.
So takeaway there is real estate doesn't avoid deflation. It tends to get hurt by deflation. So you want to make sure that you're unleveraged in the 2030s. That you're in demographically superior states in the United States, and that you can suffer through a lower than normal occupancy level and have the ability to carry it that way for 4 or 5 years.
Okay, so Brian, I don't think you've made the case for why that deflation will happen in the 2030s, though. What brings that about? Is it just demographic decline in China? Is that?
Well, think of it this way. It's not just China, it's also going on in Europe. But imagine you're a manufacturer, okay? And you've been building up your manufacturing capacity to service more and more people all the time. Now, there aren't going to be that many people in China and in Europe. So what are you going to do with all this capacity? Some of it you're going to write off, right? Just shutter it. But the stuff that you want to keep running, how are you going to get your product out there when there's fewer people to buy it?
Right.
You're going to drop the price.
But okay, so just to play devil's advocate with you for a moment, I see where you're going and it makes total sense. The only thing it doesn't tell you is that maybe people just increase their consumptions or their wants, and that's the thing we've really discovered is that human wants are just completely unlimited. There are things people want that we can't even fathom today that we will see in the next few years that are going to be necessities for people, right? Maybe you can address that.
That's true of wants, but that's not true of ability.
Yeah.
Ability to buy can be disrupted in the short term. Sure. And that gets us into the longer term perspective, Jason, and for us, it boils down to demographics, healthcare costs, transfer payments, and what that all means for the U.S. national debt, which is now running at about 120% of GDP. Mm-hmm. 800 years of economic financial history show that that's not sustainable, that something is going to change. And with China waning, Europe waning, who's going to be lending us that kind of money? We're going to be printing it ourselves, I suppose, which is going to lead to rapid inflation, which slays your economy from within. I mean, it's just an untenable situation. So the consumer's ability to satisfy all those increasing wants will be disrupted because of the unstable financial condition that our government is leading us into.
hmm Yeah, and then the other thing about the deflationary aspect, and it makes sense what you're saying there, but you have to sort of weigh that against the money creation concept, which is inflationary. So which one wins that battle? Is it lower demand and lower consumption wins? And when I say wins, I mean causes inflation. That's not necessarily winning. I should define that. Or is it just this massive amount of new currency chasing a limited supply of goods and services? It's very hard to tell which thing will win that, right?
For me, it's not that hard, Jason. Okay. And the reason is it has never worked out with a happy ending. All that excess inflation has inevitably turned into some period of deflation throughout economic history. So the argument can be made, well, this time it's different. Those are the most dangerous words ever uttered, right? So I don't believe that this time it's different. So it's just a function of when, not if, in my mind. And when I look at things like these demographics, and I look at the magnitude of our debt, and I look at the demographic shift and the drain the boomers are on the economy, it all suggests to me that there's this risk of deflation out there in the mid 2034, 2036, 37, that time period. There's a long ways off. There's a lot of time for people to prepare for it. In the meantime, what we're telling our clients is real estate is a great place to be. If you're a boomer, it doesn't matter. But I'm talking to millennials, and I just don't want them to think, well, I'm just going to buy this and buy more and more and more and build up this great empire, and it's going to be happy every year of my life. It isn't going to be that neat because of the excesses of the past.
Okay, good stuff. So take us through some more of this. So this is the CPI. Of course, that's the major index for inflation. What is that going to do?
Well, as you can see by the orbs I've drawn on here, we expect inflation is going to continue to reduce. And in 2024, it reduces to a point where the Federal Reserve is going to be able to declare victory over the war on inflation. You'll also see, though, that we don't have the trend line going down below zero because we are in a tight labor situation for many reasons. And that isn't going to go away. And the Fed has no playbook on how to bring inflation down when there just aren't enough people to hire at any given time. We see unemployment has gone up to 3.9%, which is still below the full employment rate historically. And unless they're going to cause a cataclysmic decline in the economy, which is not their goal, we're going to see wages are moderating on the way up, but they're still going to be going up. And they're not going to be able to get us down to that 0% rate of inflation that we have seen before. But they'll be satisfied with the 2%. And that means, and I realize not many people are saying this right now, we expect that the Fed will be lowering the Fed funds rate in 2024, that they'll lower it between 50 and 150 basis points, which is something they said that they are prepared to do if circumstances arise that dictate that they should. Yep. And at least the initial decline is already built into the futures market, which is a highly accurate way of looking at what's likely going to be going on in interest rates. TD Bank, by the way, and I saw a document, they didn't explain why, but they expect interest rates to go down 300 bips in 2024. I'd love for them to be right, but I'll take 150 bips because that's going to help everybody in this economy, including and maybe in particular the housing market and
right.
Stay out of the commercial real estate space, that's all.
That means that the prediction is, and based on the futures market, a highly accurate way of knowing where things are going, that we will see interest rates decline by 0.5% to 3%. So that's very significant. Wow.
Wait. No, you're misstating.
No? Okay.
The model is saying it could be only a 25 basis point decline. In the first half of 2024. It may be 50 basis points. The model isn't good enough to detect the difference.
Okay.
And the only one I know of that's saying up to 300 bips is TD Bank. Nobody else that I know is saying that. So they're the outlier. But
okay, so they're saying that we would see a significant rate reduction, but they're the only one.
Right. And I hope they're right. But and they're not slouches over there. So they're worth paying attention to.
Right.
So that sets the stage for some nice growth in the economy beginning in 2025 and running through the end of this decade, in our view, which is fantastic for real estate. We got a lot of people, a lot of money in this country. Incomes are going up. Single family housing is going to be sluggish on the upside, although that is improving as we speak. But to me, that just means all the more I got to be involved and be invested in the multifamily type real estate opportunities.
Well, so multifamily has really been struggling a lot lately, though, Brian. I'm kind of surprised you say that, because the narrative we've been seeing, and we've had guests that have talked about this too, is that the multifamily is really quite oversupplied at the moment. I mean, I have a lot of friends in that business, and I'm in that business too, but the single family is quite undersupplied. So tell us about that, if you could peel the onion back on that one.
Yeah, the onion on that one is this next slide, and it's my last slide, where we're looking, and this is something we created at ITR, average household income, surplus or deficit relative to the income needed to afford the average priced home in each state. So for instance, in California, your average household income comes up $124,000 shy of being able to afford your average house in California.
No surprise there, but yeah.
Right. And you'll see that in the middle of the country is where you get most of the sanity, very pale colors, very modest negative numbers, and even some positive numbers. So this is a structural imbalance that's going to take some time, Jason, to work through the marketplace. People are going to have to get used to, because the cost per square foot isn't going to come down appreciably, and mortgage rates aren't going to come down appreciably. They're going to have to get used to a smaller footprint. And that's a cultural change that is going to take time to go through the millennials.
I am so glad you recognize that. It seems like every economist I talk to, they just don't seem to recognize the idea that people will just accept less. I mean, folks, that's what inflation does. It lowers the standard of living. You see, it's not the same buyer. The same buyer does not buy the same house that they used to buy decades earlier. They buy a lesser house. They accept less. When you have higher interest rates and higher prices, it takes a while, but in a year or so, you're going to come around to, look, this is all we can get. I mean, everybody wants more. Of course, every consumer wants more than they can afford. Yeah, I mean, there's a saying for it, champagne taste on a beer budget, right? Yeah. And so everybody wants more than they can afford, but they eventually come to the hard realization that, look, this is what we can afford, so that's what we're going to accept. And when you compare the United States to the rest of the world, you're getting a lot more here than you're getting with, a little flat in Europe that you would buy or rent that's, 700 square feet. Here you're buying a 3-bedroom, 2-bath suburban home that's 1,800 square feet, or, maybe 2,200 square feet with a 2-car garage and a yard. So I'm so glad you recognize the idea of capitulation, right?
Oh, yeah. Most economists. I don't think that that has been broadly understood and accepted yet, and I hope you're right about it only taking a year, Jason. But I think it's going to take longer than that for the cultural tide to change. So,
well, it changes slowly. It's a very iterative, incremental thing, right? It changes day to day, week to week, month to month, right? As people just move and make decisions in the economy and accept less and less, and then suddenly 10 years later, you think, wow, the standard of living really did decline.
yeah, exactly.
Right.
Now, in terms of the multifamily, when there's negative news, I'm the type of investor with it. Then when there's negativity about a sector, I'm interested. I'm going to start looking around for the right buying opportunities. Right. And there's enough negativity out there to spark my interest. I enjoy being counter to the mainstream thinking.
Right.
So that's
okay. So you're contrarian in that. So that explains it. The thing about being a contrarian is that it makes sense. I mean, you could argue that there's a lot of negativity about the single family market and the real estate market in general. The question is, at what point in time do you come in if you're probably doing the fool's errand of trying to time the market, which usually doesn't end well. But, right.
So the time is, it varies from deal to deal. It varies from location to location.
Sure. Yeah, absolutely. Let's tie this in with the rental market. If we look at this map that you have on the screen, and we see that obviously housing affordability is not good, right? So since the interest rate hike occurred, only approximately 5 million transactions have happened. So there's about 140 million housing units in the country. And so 135 million people have these ultra cheap mortgages and they're quite comfortable. 42% of them have no mortgage at all. They own their house free and clear. Okay. So that's one segment. But then you look at the pent up demand of the people who got priced out of the market, and only about 5 million have purchased since the rate hikes, right? So what do all these other people that want to buy a house, what do? They have to rent. So what do you see happening in terms of rents? It seems like there's just a lot of increasing demand for rentals as housing affordability is poor.
You're making my case for me. That's why I like that space. There is a lot of demand for rentals. And what you're going to see, and it's subtle and it doesn't impact real estate investors, but what you're going to see is as these younger folks, millennials, strive to get into this housing market, they are going to be forced to rent. But as they try and save up that down payment, they're going to give up on other discretionary spending items, which goes back to, they always want more. You're absolutely right, Jason, but they're shifting their focus to what can I give up today so I can get that longer term more want satisfied. And I think you're going to see that going on over the next 2-3 years.
What else do you want people to know, Brian? Maybe just a question I haven't asked you.
We think that there's a significant shift coming in the global sphere in the 2030s. And while it's nice to say that's still a long ways off, if you're a millennial or a Gen Xer, I'm not sure you have that luxury. So when we're talking about making the 2030s very real by age demographic, these are the changes we see coming. And this is how you benefit from them if you're a millennial. This is how you benefit from them if you're a Gen Xer. And this is how you're a problem if you're a boomer, and what you need to be talking to your kids about. It's our attempt to make a longer term view very personal based on your age, because we get asked those questions all the time.
Yeah, good to know. And Brian, ITR Economics, check out their stuff. It's great to have you back on the show, and we appreciate all the insights.
Good to see you, Jason. Thanks for having me.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.